right, Tom. So, 2023, we turned in 24%. 2024, we turned in 23%. Pretty good this year, too, 17%. Next year, we fill in the blank with what sounds reasonable to you.
I think it's still possible to have a double-digit year. There have been 12 times in the last 100 years where markets posted 3 years of 20% gains. This year hasn't finished yet. Globally, half of the time, markets do even better in the following year. So I think next year is a year where the debate's going to be, is the bull cycle over or is it going to extend? I think it's going to create quite a lot of volatility in the first half, but I think GDP growth stronger. We have a dovish Fed. Valuations are reasonable, so I think we end up exiting very strong.
Why a lot of volatility in the first half, then?
Part of it is the Trump tariffs could get overturned. There is a possibility of an extended government shutdown. The nomination and then confirmation of a new Fed chair is going to take 3 months. That could be very controversial. I think all of that happens in the first half of next year.
How's that sound to you, Steph?
I think that sounds really great. The economy is on solid footing. We've been talking about that all year long. Last week, we got some really encouraging data with regards to weekly jobless claims. Inflation came in a little bit better. We've talked about the H8 Federal Reserve loan growth, lending. That's actually at a 9-week high, all-time high for loan growth. That's very bullish for activity overall. The industrial metals are at all-time highs. And you have global central bankers, including the Fed, getting more and more closer to the neutral rate. That's a good thing. And Fed cuts take a while. There's a lag impact, and I think that's going to bode well for next year. And then you have the one big, beautiful bill, $150 to $175 billion going into the consumer's hands, going into corporate America, so CapEx continues. You add it all up, and I think you have double-digit earnings growth. There are some numbers out there that are a little high, like 16, 17% in earnings growth. I'm not there, but I do think you're going to see low teens.
Mr. Harvey.
I think high single digits is reasonable.
Single.
I can't get to 10%, 12%, 15% just yet. Right. One of the things that Tom said, I agree with wholeheartedly. The first half, you're going to see a lot more volatility than you have seen in a while. I think people are sleeping on the macro risks, be it USMCA, be it the transition with the Fed. If you listen to Powell, now he wasn't cocky about this. He was very humble. But basically what he said is, I'll see you at the book signing. We have growth higher. We have inflation lower. We're back to neutral. We don't need to do anything from here. And 6 months, if you don't cut rates for another 6 months, that's an eternity in the financial markets. And then the last thing is, I think corporations are going to, after a good year this year, they're going to manage down expectations. As you manage down expectations, that puts a little volatility to the marketplace. And lastly, risk is priced very, very expensively, either in the equity markets or the credit markets. It doesn't take much to upset the apple cart.
You want to respond to that? Because it seems like, if not a step-by-step counter in some respects to your view, it certainly is enough of one. I mean, there's going to be more volatility. We're underestimating, maybe too complacent about macro risks that are out there, among other things. What do you say?
I feel good about the macro environment, all the things I just said. And I think it is a consumer that has been resilient. We've been talking about the consumer forever, how they have hung in there. Yes, it's the high end, not the low end. That tends to be the case on a regular basis, unfortunately. I don't think the AI infrastructure CapEx cycle is going to change in 2026, and that's fueling about 3/4 of the GDP growth. And I do think that we always have a wall of worry. And I've said it, you've heard me say it, Scott, I worry when I don't worry, because that means that we're complacent. I think there's a lot that people have on their minds. I think we're going to be able to get through it because fundamentals at the end of the day, they run the show. And if you do have an economy that grows 2.5%, 3%, we're growing north of that now. But if you have an economy that's growing 2.5%, 3%, typically that's been a 10% earnings growth. And I think we're going to be a little bit more. And you have lower interest rates. By the way, you have lower gasoline prices. You have lower egg prices.
But address the valuation issue that stocks are. You want to go there?
Well, it's all about earnings, though. It's if I think if earnings are growing in double digits, then I do think the valuations are very attractive, especially in other sectors beyond.